Hey, everybody out there. We're back again with Mark Collinsworth, our financial expert, to talk about what Jerome Powell, the head of the Federal Reserve, is signaling. Now, today he's indicated that interest rates are going to increase, contrary to what the expectation was that they'd be slacking off and keeping it at a 25 basis point hike. Now it seems like it may be higher than that. Mark, what do you know about this?
Well, I agree. Well, thank you, Larry. Yeah, inflation just isn't coming down, and Jeremy Powell keeps on referencing that he doesn't want to make the same mistakes that the Fed made from history, and he's referencing the 1970s. Inflation was going up, the Fed was raising interest rates. Inflation took a pause. The Fed stopped raising interest rates, and all that pause was an inflation. It gave inflation a chance to catch its second breath, and it took off like a rocket. And that's what caused the Fed to get even more aggressive in raising rates, which actually led to the big recession of the 1980-1982 recession.
So, in other words, Paul is saying there's a danger in easing off here because inflation will continue and not go down to the anywhere near the goal anywhere near soon. So, they were expecting when the Fed meets again later this month to set interest rates. The expectation was there was going to be another 25 basis point or a quarter of a percent. But now, after Powell's announcement today, does that still seem likely?
I don't think so. Looking at the Fed funds futures, traders now are predicting there's actually going to be a 65% chance that's going to be 50 basis points. And I was just looking at the euro dollar futures, and the euro dollar futures right now are pricing in 75.
Now, the termination point, as they call it, was going to be 5.1%. When the interest rates got to that amount, they were going to start tapering off. But now they're resetting that to 5.5 or 5.75% interest rates before they start tapering off because they're afraid that they're not depressing the economy quickly enough, correct?
Correct. And just to let you know, on the Fed fund futures now are predicting a 70% chance of 75 basis points
For later this month.
later this month. Yep.
That'd be a big hike. Now, the problem is the target goal of the Fed is to get inflation down to about 2%, but it was 5.4% annually. So, and it was a bit higher than December even. So, therefore, with 5.4% annually, the Fed thinks they have to keep the pressure on, correct?
Correct. And that's another interesting thing. There's actually what's called Taylor's rule, designed by John Taylor. He's actually won a Nobel Prize for his theory on inflation and the Fed fund rate. And a lot of people use this calculator to calculate. So the input is you find what you want as your inflation target. You put in your GDP numbers, what's called GDP slack, the current Fed funds rate, the current inflation rate, and it kicks out a number on where the Fed funds rate should actually be at to get to your inflation target. Well, if you go in there right now, according to uh, Taylor's rule, and I actually saw an interview with John Taylor, the creator of it, just this week on CNBC. He said at a minimum, if they want a 2% inflation target, Fed funds rate has to go to a minimum of 6.5% to achieve a 2% inflation target.
Well, and they were originally now when they started this control of the economy, it was going to be 5.1%, and they'd stop raising rates. They'd raise it to 5.1%. Now they're saying 5.5, 5 or 5.75, but you're saying even higher than that.
I'm saying what Taylor's rule says, which he won a Nobel Prize, and I've actually saw the interview with the guy. And if you had followed Taylor's rule last year it was saying, hey, you've got to be north of 6% to even have any chance of getting this. So Taylor's rule is working very, very well right now.
And as you said months ago when we first began this series of of Zoom casts on the economy, you were saying all along that the plan of the Feds is to depress the economy. In order to bring down inflation, you've got to depress the economy, and there has to be significant job layoffs. So that's the pattern that's coming true so far, right?
That's correct. Now, another problem the Fed has put itself in on that is prior to 2008, everybody had adjustable rate mortgages, or basically 88% of the population, 88% of your mortgages were variable. So when the Fed raised interest rates, your mortgage interest rate reset, and that was a big hit to consumer spending. Since 2008, 92% of your mortgages now have gone to fixed rate. And because the Fed put so much money because of 2020 COVID attack in, people are refinance their home and locking in rates at 3.5% mortgages for the next 30 years. So the Fed raising rates now is not affecting the consumer because their mortgages are fixed versus being variable. So raising interest rates at this level right now has almost no effect on the consumer.
So they have to keep jacking them up then. I mean, that seems now uh, pretty much what they're going to have to do. No doubt about
Well,
it.
well, the theory here was originally the Fed would raise interest rates and target the consumer spending by making their credit card rates too high and more to the point, making their mortgages too high. That's having a nil effect right now. So that means the Fed has got to not target the consumer directly. They now have to basically raise rates with corporations in mind because corporations need debt to keep finances going, like Ford Motor or General Motors, they have to borrow money, get interest rates on those bonds so high that a General Motors or a Ford has to start laying off massive amounts of people to get the consumer to stop spending. So instead of slowing down consumer spending through higher credit card and mortgage payments, you now have to target the corporations and force the corporations to just fire people.
Well, how does this fit in with Biden's bragging several times in recent months about how great the economy is doing? The unemployment rate is low, wages are up, everything's great.
That's actually a bad thing because when wages start going up, that increase in wages makes that inflation permanent. So if wages are going up, the only way that you can get inflation, because if you're making $10 and then you get a pay raise to $15, that's an extra $5 in the economy. You can't sit there and go into the employee one day and say, hey, we're cutting your pay from 15 to 10. You have to go in there and just fire them completely. So what Biden is basically doing is bragging about the economy. He is basically setting people up to take massive job losses to fix his problem.
Well, and even while people have their jobs with those pay raises, the pay raise increases are not keeping up with inflation. So they're actually continuing to lose money.
They are. And each time those pay raises go up, that makes inflation just that much harder to come down because it's more money going into the economy.
So, Mark, again, my favorite question, where is all this going?
Eventually, we're going to have a pretty bad recession if the Fed keeps raising rates at this rate.
Right now, the Fed rate is up to what?
4.5%.
4.5%. And they originally thought they could level it off at 5.1%. But now there's predictions even 6% or higher.
It goes back to Taylor's rule. When the Fed was saying 5.1%, Taylor's rule kept saying, no, you need to be at 6.5.
Yeah.
So I think right now, for the past year, Taylor's rule has been calling for 6.5. And here we are having to change every few months saying, oh, we can stop at 3%. We can stop at 4%. We can stop at 5%. But Taylor's rule keeps saying 6.5.
Mark, what should have been done differently was not to avoid this consequence?
What they should have done is after they flooded the economy with all that COVID money, they should immediately, and everything, kind of passed and started stabilizing, they should have immediately started raising rates at least at 25 basis points a meeting, and they should have stopped their QE program completely.
So they should have done these things sooner.
They should have done these things in probably the late fall or early winter of 2020.
Well, you've said a number of times that the Fed usually
A dollar short and a day late.
hour short in a day wait. So, in other words, they didn't act quickly enough or severely enough. So that phrase is that saying has kind of been borne out here.
Yeah, and they're still not acting quick enough. They're
Yeah,
way, way behind the curve.
and then you've also said that the Fed will. It reaches a point where the Fed overreacts, and then the damage is more severe than it should have been and could have been if they acted sooner.
Could have been. And there's actually a few more problems out here with the inflation, which the Fed could be making a mistake also, is that, when we talked about back here in 2021, how there's like something like 70 cargo ships off the coast of California, and it was taking like 60 days for them to get unloaded because it had all the cheap Chinese goods on them. We're now starting to see kind of a reverse of that. with China now starting to reopen. As of when I checked Friday, there were 33 empty cargo ships off the coast of China waiting to be reopened for the factories to be reopened and load those cargo ships on. Now, here probably in the next few months when the factories get going and they load those cargo ships up and it takes a month for them to cross the ocean, you're going to start seeing cheaper goods start to flow into the United States, which is going to start driving down inflation. Is the Federal Reserve taking that in consideration? I don't think so. They're going to raise interest rates too much. And I think you're going to see in the second half of the year, you're going to start seeing inflation coming down at a fairly steady clip.
So the fix is coming in the second half of the year. It's going to.
Correct. Here's the problem. The Fed's going to raise interest rates, and what would naturally occur of a natural decline of the inflation rate down to, what we said we'll go, it was like 5.4, getting it down naturally to maybe 3.5 to 4, the Fed's going to overdo it and overshoot, causing a recession to drive it down a lot further. So they're probably going to hit their target 2%. They're just going to hit their target of 2% by making massive job layoffs.
All right. So, wow. Again, a bleak picture. So you're the financial advisor to a lot of clients. What are you telling them these days? How should they be investing their money, or should they be investing?
Well, yeah. Right now, you can go out and buy a 6-month treasury bill that matures in 6 months and get 5.25% on it. Why would you want to invest in the stock market with all the volatility had like today was down 1.3% or something? You can be in a T-bill and be guaranteed to earn 5.25%.
Well, that's a bit of very valuable advice. Anybody out there who's listening, how they should be using their money these days. Now, go ahead.
Okay, and here's another thing people are not forgetting is every April, banks are required to do their annual stress test on their loan books to make sure we don't have another 2008 crisis, right? So they're required to run a 2% shock to their loan portfolio. So what will happen to that loan book? How many loans will go into default, become delinquent on a 2% increase in the Fed fund rate? Well, here's the big question. When they ran their annual report last year, that was in April. The Fed had only raised interest rates at 25 basis points, but they're required to do 200 basis points. Well, 200 basis points, that's just a hypothetical number. You were way off. The Fed had only raised 25, but you shocked it for 200. Here's the big question. They're going to have to run that report here in another 30 days. Are they going to run it at a 2% shock? Because they run it at a 2% shock with interest rates being over 4%, they're going to dramatically underestimate the riskiness of bank balance sheets. Or are they going to go ahead and say shock it at 4.25%? And if they shock it at 4.25%, you're going to have some banks that are going to have to be forced to cut their dividends if they fail the stress test.
What do you think they're going to do?
I think the Fed's got itself in a problem. I think they're going to stick with the 2% shock rate because I don't think they want to see what happens to those loan books at 4%.
Now, Mark, I hear this argument repeated quite often with all this economic turmoil that really what's going on is companies taking advantage of the so-called crisis and hiking prices, price gouging. That's what's really causing the price rises. What do you think?
No, it's not price gouging. I mean, that's just something that Democrats want to argue and say, hey, that's what's going on. That's not what's causing it. It's supply and demand. If you have, let's say 20 widgets and you only have 10 people out there bidding on those 20 widgets, well, those prices are going to come down because you have more widgets than there are people wanting to buy them. But when you have 20 people wanting to buy 10 widgets, those 20 people now are just like at an auction. They're all bidding because they want and need those 10 widgets, and that drives the prices up to whoever has the most money to actually buy the widget.
And there's no kind of price gouging going on in any industry.
No, if there was price gouging going on, you would see profit margins expanding because they're making a higher profit on the higher wages, but you're not seeing the profit margin expansion. You're actually starting to see profit contraction at a lot of these companies. And that tells me that these companies are selling their products at cost just because they've got to get the product off the shelves and they're willing to take a small loss to get rid of it.
Well, oil really drives the economy, controls the economy. And the Biden administrators have been saying for a long time now and continue to say that oil company profits are extraordinary. You know, that they're higher than ever. Therefore, what they're doing is taking advantage of the situation and price gouging.
No, then if they're price gouging, why aren't their profit margins increasing? I don't know how that's possible. But here's the big one: they're complaining about these energy companies, all these mass profits. When the energy industry was on the verge of going bankrupt in the early 1990s, I didn't see anybody raising their hand saying, "Hey, we got to bail out energy companies."
So, in other words, what you're saying is their profits are higher, but not the margins
The
of the.
margin. So it's like this: if you were making, if you sold $100 of something and you collected $10 on it, well, you're still collecting. You're making a 10% profit margin. But if you sell $150 worth of something and you make $15 on it, that's still just 10%. Yeah, it's a higher profit, but the percentage is staying the same.
All right. So, in other words, since they're paying more to buy or extract oil, they're charging more for it, but the margin is not increasing.
They're charging more because it's becoming more costly. Like, we talked about wages going up. When they have to, because they don't have employees to drill the oil, they have to raise the price of their salaries to draw more workers in to drill the oil. That higher wages gets passed on to the oil price to pay for those wages. So when you pay the higher gas price, you're not paying the price gouging, you're paying for the company having trouble finding workers, and they're now having to go give higher wages to attract those workers in. Higher wages equals higher inflation.
So, in other words, even though they're making more money, they're spending more money to keep the business going. So the
Correct.
actual profits are no higher than they were before.
Not on a percentage basis, no.
All right. Mark Collinsworth of Vere Global Financial Wealth Management, thanks once again for explaining to us how the wealth is being managed.
Anytime, Larry. As I always say, it's always the darkest before it gets really freaking bad.
Another bright note for Mark Collinsworth. Okay, Mark. Talk to you soon.
Thank you.